In 1929, 9,000 banks in America simply ceased to exist, shut down suddenly, destroying the savings of ordinary people who behaved impeccably. This episode is known to everyone, but there is a detail that is persistently not mentioned. Certain citizens preserved everything, not thanks to wealth or acquaintances. They applied a state-backed savings scheme that increased by 800% in the epicenter of the Great Depression. Starting from the 67th year, it was excluded from all educational programs on money management. The widespread belief states that surviving a bank collapse means hiding cash in secluded places or switching to precious metals. In fact, everything is much darker and more applicable. Those who passed through 1929 unharmed relied on a completely different construction. It functions even in 2026, however. Almost no one talks about it. The reason for oblivion is capable of radically changing your perception of the current location of your funds. Distributed protection that shielded them. To begin, realize the aspect of 1929 that rebuilds the entire history. Not all banking fiascos were the same. In the period from 1930 to 1933, approximately 9,000 banks in the United States ceased to exist. This looks like absolute system collapse, and for commercial banks, it was almost completely so. However, there existed a separate category of organizations operating in the same populated areas, serving the same residents, with a radically different degree of survival: mutual savings banks. These institutions were not controlled by shareholders. They lacked a profit motive, prompting dangerous investments. Their legal form put depositors first. In such states as Massachusetts, New York, and Connecticut, mutual savings banks withstood, while commercials around them collapsed. In New England in 1929, more than 160 such banks operated. By 1934 year, the overwhelming majority remained open. In contrast, over 40% of all commercial banks nationwide disappeared in that same interval. This is not an insignificant figure. This is a fundamental element hidden from view. Those who survived 1929 intact did not guess with a single bank. They comprehended that the organization's construction matters more than its name. A commercial bank in 1929 could take your deposits and direct them to aggressive loans, loans under stocks for speculators, risky real estate, corporate bonds in pursuit of yield. When the market crashed, these assets turned to nothing. Your deposit followed them. The Massachusetts Mutual Savings Bank functioned under state oversight, prescribing cautious investments, predominantly mortgages, short-term, without involvement in stock exchange gambling. Here is the practical significance of this for 2026 year. Mutual savings banks exist to this day, as do savings banks with credit unions built on the principle of depositor priority. Credit unions are structurally identical to those ancient mutual banks, owned by participants, not shareholders. Their deposits are protected by the National Credit Union Administration, NCUA, a federal guarantee distinct from FDIC. Thus, deposits in a credit union and commercial bank are covered by different mechanisms. Place $250,000 in a commercial bank and $250,000 in a credit union, both amounts insured separately, not in one insurance fund. You operate in two different legal and oversight environments. This difference weighs more than it seems. However, the distribution strategy penetrates deeper. In 1929, those who truly understood risks did not limit themselves to diversity of institution types. They divided by levels, federal against state chartered. Each had its own oversight rules, investment limits, capital requirements. When waves of state banks crashed down, federal members of the Federal Reserve System received emergency funding unavailable to others. Today, this translates directly into commercial banks with FDIC insurance, credit unions with NCUA, and above both, a separate structure requiring no insurance at all. After all, insurance is needed when an intermediary might collapse. But what if there is no intermediary at all? The system absent from training. Here it is, a fragment of American financial chronology, effectively removed from programs. In 1910, Congress established the United States Postal Savings System. The idea was elementary and breakthrough. Citizens could deposit funds at any post office in the country. Money was held by the Postal Service. Full faith and credit of the U.S. government, without private banks, without insurance pools, direct guarantee. In 1929, the total deposit volume was about $153 million. A little, mainly for immigrants and rural workers not believing commercial banks. Then mass closures began. By 1934, deposits reached $1,200 million, growth of approximately 800% over 5 years. Not due to marketing, not because of attractive rates. The system paid 2% per year, deliberately restrained to not compete with banks directly. People rushed there because every depositor remained protected in the most terrible banking crisis in history. Not a single lost cent. Not a single bled-dry depositor. This is the real 1929 tactic. Not gold, not hideaways, not rearrangements between commercial banks vulnerable to one systemic blow. Complete withdrawal of funds from banking infrastructure and placement directly with the state. The system was abolished in 1967 not due to failure, due to excessive efficiency. Banks lobbied against it for decades. When post-depression transformations stabilized the banking sector, the political justification for state competition in retail deposits vanished. Congress liquidated it. Why is this absent from every finance guide? The banking industry has a clear interest in hiding the historical example where direct state deposits outperformed the banking system on all metrics in crisis. The postal system, eternal accusation against the thesis of banks as ultimate shelter. Now the moment that should make you think. A functional analog exists today, in plain sight, almost completely ignored by personal finance mainstream. TreasuryDirect.gov, managed by the U.S. Department of the Treasury. TreasuryDirect allows any American citizen to acquire Treasury securities directly from the federal government, bypassing banks and brokers. Treasury bills, notes, bonds, I-bonds, Ts, all in an account registered directly with the Treasury. Not in a brokerage firm, not in a bank, with the Treasury itself. Buying a 4-week T-bill on TreasuryDirect, you lend directly to the United States government. No bank in the chain, no need for FDIC. FDIC insurance protects from intermediary failure. Without intermediary, nothing to insure. Either the government returns it or not. Only one counterparty. T-bills on TreasuryDirect can automatically reinvest. The 4-week bill is redeemed. Funds instantly buy a new 4-week one, unless specified otherwise. Liquidity through shortest terms. Funds fully outside the banking system. No banking holiday will freeze a TreasuryDirect account. No depositor run will touch it. When in March 2023 Silicon Valley Bank collapsed and Signature Bank followed within 2 days, depositors in the banking system panicked. Holders of short-term T-bills on TreasuryDirect noticed nothing. Structural separation worked as archives foretold. Most miss the psychological trap that TreasuryDirect solves. In a banking crisis, instinct seek a more reliable bank, but under systemic stress, hunting the best bank misses the mark. System under pressure, the whole system. 1929 strategy, exit from it to something fundamentally different. TreasuryDirect, that's the exit. Postal system rebuilt for the digital age. 2023 users didn't suspect they were following the 1930 scenario, but they were. The wall invisible to the eye. Let's move to the mechanism the crowd misunderstands. It determines if the listed measures suffice. FDIC insurance arose in 1933 precisely because of the 1929 fiasco. Today it covers $250,000 per depositor, per institution, per account category. For typical amounts it seems comprehensive, but talk cuts off there in vain. In 1984, when Continental Illinois, the 7th largest U.S. bank fell, FDIC covered all deposits, not just insured ones, fully, including corporate accounts far over the limit. Why? FDIC calculated that uninsured depositor losses would trigger a chain reaction. Large clients of other banks would instantly withdraw funds. Consequences would exceed the problem itself. The lesson is not that FDIC is meaningless. The lesson is that crises ignore strict rules. They bend for systemic resilience. Coverage you count on may differ from reality, sometimes broader, sometimes in small fails, strictly by limit. Builders of truly resilient cash positions in 1929 did not rely on a single tool. They layered independent levels and accounted for the specifics of physical cash, which today goes unmentioned. During a run, not all cash is equal. When in 1930 regional banks suspended operations, merchants accepting checks switched to demanding bills. Holders of large denominations couldn't change them. With small ones, 1s, 5s, 10s, deals went routinely while neighbors paralyzed. Oral histories of the Great Depression collected by the Library of Congress are full of testimonies. Cash was there, but useless due to lack of change in the era of shortage. The modern variant is simpler and more curious. Physical cash in small denominations, stored outside banks, serves as a transaction layer with zero counterparty risk for emergencies. It brings no income, loses value due to inflation. Therefore, mainstream advice ignores it. However, a stockpile for 30 days of ordinary household expenses in small bills somewhere besides a bank means that a banking holiday, cyber attack on payment network, or acute regional failure will affect you differently than those on digital rails. Architecture in detail. Exact reconstruction of the 1929 strategy for 2026. Layer 1. Operating funds and FDIC insured accounts of a federal commercial bank. For daily operations, keep below limit. This is your utilitarian level. Layer 2. Additional cash reserves in a federal NCUA credit union, structurally isolated from FDIC. Different oversight rules, different failure scenarios. This is redundancy. Layer 3. Short-term treasury papers directly on TreasuryDirect, fully outside the banking system, without insurance limits, direct link to federal government. This is the revived postal savings scheme, your fundamental separation level. Layer 4. Physical cash in a mix of small denominations, stored offline, not as a base but as a transactional bridge for periods when digital payment paths or bank access are temporarily disrupted. 1, 2, 3, 4 weeks of household expenses. This is the continuity level. This construction is not extremist, not a doomsday portfolio. This is a literal translation of the actions of 1929 survivors into the arsenal of 2026. No layer is tuned for yield maximization. You won't soar on returns with this setup. T-bill yields competitive but not phenomenal. NCUA savings rates follow FDIC. Physical cash gives 0. This is insurance architecture, not investments. Mixing concepts, root of unpreparedness. How banking fails happen in reality. One more 1929 lesson that modern analysts skirt. Bank crashes do not occur instantly as the term implies. They develop over months before the sharp finale. Signs are visible if you know where to look. Banks of the first 1930 wave had a common trait before collapse. They quietly reduced reserves, cash relative to deposits, to expand lending capacity. Reserve data was available. Most depositors did not check them. Modern depositors lack direct access to internal reserves. However, FDIC publishes quarterly call reports on every insured bank in the country. Open data on capital ratios, loan delinquency levels, risk concentrations, net interest margin trends. If you want an early warning system for your banks, the raw material is on the surface. Most will never open a call report. In most cases, FDIC covers standard deposits and routine. The scenario where this is critical, not routine. Multiple institution stress, rapid outflow from the insurance fund, real-time regulatory decisions on bank and depositor priorities. In March 1933, Franklin Roosevelt declared a nationwide banking holiday. All banks closed for 8 days. Deposits frozen, not lost, frozen. Those with assets outside the banking system continued operations. Those dependent on bank accounts 100% no. Banking holiday, not archaic. Activation mechanisms exist in 2026. Large-scale cyber attack on payment infrastructure. Rapid regional contagion after a major fail. Regulatory decision to buy time by slowing outflows. The postal system grew 800% not because someone foresaw these scenarios. It grew because the unforeseen occurred. And those who relocated in advance found themselves in a different reality than those deciding in chaos. This hides an accounting principle rarely stated explicitly. Your bank deposit, your asset, bank's obligation. When a bank fails obligations, your asset is under threat. This is not theory. This is the experience of depositors who lost savings in 1930. They followed all canons, used legitimate banks, were prudent, held claims on institutions that fell. Your T-bill on TreasuryDirect, claim on the US federal government, not on an intermediary, not on a holding, on the government itself. This difference, entire architecture of financial resilience, precisely why the postal system worked when 9,000 others did not. The 1929 strategy was not complicated, did not require special access, deep knowledge, elite connections, required grasping one structural truth and acting before crisis, not in it. By the moment queues lined up at banks in 1930, those who needed to act had missed the window. Deposit frozen, withdrawal denied, savings evaporated. The postal system window remained open. It was always open. Subscribe to the channel. Every video assembled the same way. Not from sensations, but from documentary traces of what happened when trusted systems failed. The most dangerous financial illusion, not that banks are risky, but that since your money looks the same in the accounts every morning, The structure beneath must be reliable. Rome's denarius also looked stable, until it didn't. The question worth pondering this evening, not in the safety of your money, but whether your wealth is in a construction that can honestly answer this question if rules change.